everybody. Welcome to this edition of the Allocation Advantage. This time we're talking about timing. We call it the disciplined dividend. Really speaking about having patience as an investor and not reacting and making those emotional decisions based on any given news headline. So where are we coming from here? Over the last 2 generations, the average holding period for a stock has dropped from 8 years down to 10 months. So a 90% drop in that holding period. Why has that happened? Of course, commission-free trading, DIY investing has made that more possible, more cost-efficient to trade in and out of positions. There's all sorts of options available, including retail options platforms, where you can really make huge moves in your net worth in seconds, really. But it does get a little close to that gambling side of things when you're making such short-term moves without the education behind it. And of course, there's some rules that have changed both sides of the border on investing. But last and definitely not least is that social media piece, the finfluencers, that mindset of keeping up with the Joneses, seeing all the good that's put out there on social media, all the positive, the wealth, the exuberance that's out there without seeing the negative. You kind of have that gambler's fallacy out there where you're really only seeing the positive and not seeing the negative side of some of these investments. And of course, you never know what is true and what isn't on social media. So one of the things to consider here when you are looking at investment selection, or I guess recommendations that you're seeing, whether it's from social media or you're looking online or on TV, you see somebody recommending a stock. Do they know your tax situation, your time horizon, your liquidity needs, your estate plan? Do they know anything about you and your goals? Obviously they don't. So you really need to incorporate that into your own investment decisions. Which account should those investments go in? That sort of thing. How long do you have? How old are you? Is this for retirement, or is it for your kids' education? Have you made a time horizon decision? Do you need cash flow at any point here? Are you about to retire? You're going to need to pull funds out? Or do you have a home renovation coming up that you need funds for? And what's the long-term goal? What's your plan? What's the estate plan? All of that needs to be incorporated when you're making your investment decisions, and nothing that you see online or on TV or on social media has anything to do with you incorporated in. So what are the benefits? How do these returns, these greater returns, where do they come from when you're a patient investor? So compounding, which you've probably heard, is by far the biggest power. The longer your funds are in there, the more they're going to compound on top of each other. A lot of the legwork is done towards the end. As your funds compound year after year, the dollar gains that come out of that really start to show towards the end. So anytime you're interrupting that by pulling funds out, by either spending those funds or even just pulling them out of the market because you think it's too scary, you miss some of those positive days, and that compounding is interrupted. So really something to think about there. I know everybody's had the thought of things are going terrible in the world right now. I'll just sit out until things settle down. That never works. You're always settling. When things have settled down, the markets are already back at all-time highs, and you've missed a lot of the gains. So that it really removes that when you take a good hard look at how you're building your portfolios. The tax efficiency side, we talked about this a little bit in the last slide, but where your funds are invested, which accounts you're using. Do you have a corporate account? Have you filled up your TFSA? Are you looking at RESPs and getting the grants from that? All of those things. And then in which of those accounts are you investing? So if you have a taxable account, are you using tax smart investments in there? Are you paying those dividends and interest and income, adding to your personal taxes? And last but not least is corrections. We noted there, corrections as an inventory. When you have a plan set out, ready to achieve your goals, that should put you in a good position to take comfort when things get negative, when there's volatility in the markets. You won't be stressing as much about selling and running for the hills. And 2, you'll be able to look at it as a bit of an opportunity to either buy more or to at least rebalance your portfolios into that volatility so that you can make more on the upside when you inevitably come out and the markets return to all-time highs. So having that owner's framework as opposed to a renter's framework really helps. So defining that longer term time horizon. Again, if you've got a longer term goal as far as retirement or kids' education goes, you're not so worried about the short term headlines, because you know eventually those markets are coming back to highs, and you're going to benefit in the long term. Looking at the step number 2 there, the inputs that you're dealing with, you're not being influenced by the finfluencers of the world and social media, or at least knowing the background on some of that, and realizing that if those stories are even true, that's a very small percentage of what reality is like, as far as investors go. Uh, Committing to rules ahead of time. So not when the markets are volatile, either positive or negative, are you changing the rules, but really making those rules set ahead of time. So again, one thing we do is regular rebalancing. So when the markets are at extreme highs, then some of those high correlated market positions will be chopped down a little bit, added to some of the uncorrelated pieces of that portfolio back to the weights that we wanted them to. And then the reverse can happen. So when markets are way down, then we are chopping at some of those uncorrelated pieces and adding to the ones that are more market exposed, knowing that those are going to rebound. So that's one rule to put in place, but creating those rules and sticking to them despite the volatility. And when we speak about volatility, last but not least, we spoke about corrections. Really having that mindset that the volatility can be used as a good thing. The more that the markets are moving up and down, the more we're able to rebalance and get before things come back to the mean, the more added return we can have. So, and of course, if markets are way down and you happen to have funds set aside, then using that mindset to be able to add to your investments in that is definitely going to help as an owner. When you look at it as a renter, you don't have that same mindset. So some of the pieces of being an owner, evaluating those positions from a long-term perspective, making sure your asset allocations, you're well diversified, using volatility as an opportunity, looking at years as far as your performance go, not looking at days or weeks, and aligning how that compound growth actually works with how your plan is set up. So, and of course the opposite there as a renter, looking at the short term and really reacting, making those emotional short-term decisions in your portfolio. So just to conclude there, how we've created our portfolios and how we hope you are looking at yours is looking at long-term asset allocation, exposure, well-diversified portfolios, really going to help remove the emotional side of investing, taking that long-term approach. You're going to see an endless amount of social media one-offs where somebody invested in some stock, or your uncle's neighbor told you about some cryptocurrency that's gone through the roof. You're going to continue to hear those stories. But just know for every one of those, there's probably thousands that have gone the other way. And that if you can create that long-term plan, that owner's mindset, and really stick to it and get the compounding going for you, you're going to achieve all those goals. And we're happy to help show you how to do that. There's a free retirement planning webinar you can sign up for there. Gives you some tips on planning ahead and potentially retiring early if that's your goal. Or we are happy to have a complimentary consultation, no obligation, give you an idea of what we do, how we can help, and a second opinion on what you're currently holding to see if there's a better way for you to invest. As always, happy to chat. Look forward to chatting with you. Until the next time, take care, everybody.